Hello and welcome to Livewire Markets. My name is Chris Conway. Today I am sitting down with Roy Keenan. Roy is the co-head of fixed income at Yarra Capital Management, and he's also the portfolio manager for the Yarra Enhanced Income Fund. He joins us today as part of Livewire's income series for 2024. Roy, it's great to see you again.
Hi Chris, good to be here as always.
Roy, the Yarra Fixed Income Department prides itself on having a view across the entire Australian fixed income landscape. What are some of the core views that the team holds right now across the opportunity set?
Yeah, look, it's an interesting marketplace for us. We think it's a market whereby we're trying to preserve income and target quality income. So in some ways we're up the credit curve. Yep. We're doing that in things like RMBS. We really do like, despite credit spreads coming in on RMBS, but we also do like IG credit. We think also IG credit's offering really good returns at the moment. But it also feels like a market where you want to be avoiding potholes and having mistakes. The last 12 months to 2 years have been really good investing period, but we are really conscious of not making mistakes in the current market.
Just a quick follow-up there, if I may, Roy. What are some of those potholes that you're seeing at the moment?
Oh, look, I think, if we're right, and we're going to talk about rates a little bit later, but, any company that sort of, is levered up, who's more exposed to higher interest rates, and if they stay higher for longer, they're going to come under pressure in our view. So whether that's commercial property, it doesn't matter what sort of sector, but it's sort of those companies that we're very mindful of avoiding.
Late last year, Roy, you penned an article, the thrust of which was that equity-like returns would be available in hybrid credit. We're 6 months down the road. How is that playing out and what do you think happens next? Yeah,
look, for a credit investor, that last quarter of 2023 was a fantastic period because we had higher rates, because the market was expecting RBA to tighten quite aggressively. We had credit spreads at a quite wide period. So that set our returns up for a really strong 2024, which has played out. Where we are today, and I talk about preserving income, but when I look at the marketplace, it's still a good period for credit. The opportunities that we have out there and the income that we're generating, we're sort of still looking at sort of distribution returns of 6.25%. So really around 200 basis points over cash. So that sort of appears a really attractive environment for us, especially given our view on credit at the moment.
Roy, in that same article, you said that the uncertainty, or what was unclear, is how the macro would play out. So we'll get to rates in a minute, but what's your assessment of the Australian economy and the impact that it's having on your opportunity set?
Yeah, look, it's, probably if I sort of backtrack a little bit and say, look, Tim Toohey, our macro strategist, has called the last 6 months, probably the last couple of years really, really well. And our view was that as we were approaching the bottom of the industrial cycle, it would be a really good time to invest in equities. And that has really played out well. And in some ways that's really followed through to our credit investing as well. We're approaching a period at the moment where I think, that good time for, the markets is sort of starting to evaporate a little bit. And you can look forward and say, well, growth's starting to slow. We're starting to see that. And, inflation, from the RBA's point of view, has been a lot slower to come down. So in some ways, our expectation differs from that. We think, inflation will come down and match that. But in some ways, also the economy, so in some ways we're looking for the next sort of 12 to 18 months. It's not going to be as good as what we've just seen. But from a credit point of view, slow growth, rates being a bit more sticky is a pretty good credit environment for us. So our expectations for the macro environment, is positive credit. The one thing I would say though, it has surprised us through this cycle, is how well the consumer's held up. Arrears haven't risen to the tune that we thought it would have been if you told us the cash rate was going to be 4.35. And that's the one surprise, and it's something that still baffles us a little bit, that how well they've held up, but from a credit point of view, that's really pleasing.
Roy, just a follow-up question there, if I may. I'd be remiss not to ask it. You've spoken a couple of times about preserving returns, and you said maybe the outlook for the next 12 months isn't as good as the 12 months that we've just seen. Is now the right time for investors to be locking in fixed income returns?
We do that a lot in our investing. So when we look at our investing today, we're trying to combine that macro and the credit and try and pick, is it time to be buying floating, fixed rate? We do a mix of both, really, when it comes down to it. It really comes down to when we're buying a fixed rate security, does it sit in amongst our portfolio and our expectation for where cash rates and longer term bond rates are going to be over the next sort of 12 to 24 months. So at the moment, we're running our interest rate duration at about 1.5 years.
Yep.
And we think that's really, we've set that given the environment we're expecting.
And that 1.5 years that's quite short. Is that just so you have the ability to turn the portfolio over and keep it short dated so you've got some optionality?
That 1.5 years is a bit about protecting income.
Right, okay.
Just in case the central bank does cut rates.
Got you.
But also making sure that we pick the right part of the curve, the credit, the interest rate curve, to maximise where we think the returns will be.
Great. All right, let's talk rates now, Roy. It's been a moving feast in the last 6 months, lots of expectations changing. What is the house view and what do you think happens next?
The house view, Tim's view has been that the RBA will cut rates in November. We'll follow that up with another rate cut in 2025, but it's going to be a really shallow rate cut cycle. Mm-hmm. So you're talking maybe the cash rate going to 385, 375, something like that. So that really doesn't, change my view from a point of view of what it does for our fund. High for longer is great. I just keep earning income, which is awesome. Even though you're going to get a rate cut cycle, we don't think the market's got a lot of room to rally in the longer end of the yield curve. With inflation probably going to be around that 2.5% to 3% mark, there's not a big scope for a big rally in 10-year bonds. So we think what will happen is the curve will continue, the interest rate curve will continue to steepen as the central bank cuts rates, and hence why we're positioning more in that shorter part of the yield curve to maximise the returns.
Roy, the last couple of times that you and I have spoken, you've talked about Tier 2 bank paper being your preference in the stack. Is that still the case?
Yeah, still the case. The Yarra Enhanced Income Fund, which I manage, we are running around 52, 53% in Tier 2. Yep. Probably the highest it's ever been. A couple of events that have happened back in March, Standard & Poor's and Moody's both listed the credit rating of hybrid capital. So I won't get into the detail because it'd be a 10-minute discussion, but essentially, today major bank Tier 2 paper is A- rated, which is a really high credit quality. So I continue to believe that Tier 2 credit spreads will grind in tighter, and hence why we're positioned that way.
Roy, new issuance is another thing that we've discussed in the past. There had been a lot of it. Is that still the case, and how does the new issuance impact your ability to generate returns?
Yeah, look, credit investors love new issuance, right? New primary issuance. And I have to say, probably the last 9 months has been the busiest period we've seen in a long time. It's been really busy right across the, from high yield right up into senior paper, right across the credit curve. It's been a pretty busy time for us. I find that when we look at primary deals, we tend to our philosophy is about higher risk adjusted returns. So we go in with a mindset when we look at a primary deal. Is it going to offer those greater risk adjusted returns? And we set a level when we look at a primary deal, what we'll buy that security at. And we're pretty disciplined in that approach. Primary deals can also be a very good source of lifting exposure to a credit you like. We had that case back in February of this year, if I get my dates right, back in February this year when Liberty Finance came to the market, a company and a credit we like. We felt that the senior credit rating of Liberty would get upgraded over time. And essentially we lifted our exposure into their February bond issue that they did. We were very lucky, about 3 or 4 weeks later, Standard & Poor's upgraded their credit rating from BBB- to BBB. Credit spread actually moved quite significantly lower, which was really positive return for our fund. So it can be a really good source of trying to gain extra exposure to credits you like.
Roy, performance has been good, 9.33% to the month ending May this year. In your recent monthly you talked about floating rate securities having the greatest positive impact on the portfolio. Can you just explain that, maybe for people who don't understand that so well?
Yeah, look, so floating rate securities, we're earning a rate above BBSW. And BBSW is that interest rate set that we have, and generally, our rate sets are generally 3 months, and it's pretty similar to where the cash rate will be. So today, the 3-month BBSW rate's 4.37 versus the cash rate 4.35. So the longer interest rates stay higher, the more income we are generating across our floating rate securities. And historically, we run our Yarra Enhanced Income Fund and similar other funds at around probably 60 to 70% floating rate securities. So hence why we're really happy with higher interest rates.
Roy, last one. No need to crystal ball it, but I do need to ask you about your outlook for the next, let's call it 12 to 24 months. What do you think the portfolio will look like as we move out in time?
As I've said, it's sort of a good period for credit in my view. But I'm really mindful and I'm really confident we're going to deliver the returns that we promise. And I won't put an actual number on it because I don't want to jinx myself there. But look, I think, from my point of view, growth will hold up, pretty well despite it being low. We're going to have, a central bank which is still going to have interest rates at sort of that, if we're right, 375 to 385, which is still going to allow us to produce really good income. But I do see an environment where you're going to get a period of people guessing on where the economy is going to be at, not just domestically, but globally as well. So I think you will get periods of risk off. I'm positioned for those risks off, and I always say to investors, clients, that you've got to be careful what you wish for. Yeah. But I'd be really happy to see a bit of risk off, so we could add a little bit more risk into our portfolio because we are running a higher quality than average portfolio at the moment. So I'm really confident about the returns we're going to generate.
Roy, thanks so much for sitting down with Lovewire.
Great, thanks, Chris.
If you enjoyed that interview as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.